Hi, I'm Joel Shapiro. I teach financial statement analysis at the Goodman Institute of Investment Management at the John Molson School of Business at Concordia University in Montreal. I also teach accounting to undergraduates at Ryerson University in Toronto, where I live. Anyway, here we go. This study session talks about two specific and unconnected topics: intercorporate investments and pensions. Intercorporate investments, the first one, refers to the investment that a company makes in securities of other companies, whether bonds or stocks, usually not to the extent that they involve any sort of control or influence over the investee company. And there are three kinds. If we look at the slide in front of me, you'll see that the classification of these three depends on management intent. In other words, what the investor wants to do with the investment eventually, whether they are buying them in order to sell, in order to hold. There are three different classifications involved. The three classifications are referred to as held to maturity, or HTM, held for trading, and available for sale. We'll talk about each of these three in turn now, and as you can see, they do depend on what management intent is at the time they are purchased. That intent can change. There may be changes and reallocations between classifications, which are restricted, and I'll get to that a little bit later. But in the meantime, let's talk about the individual classifications one at a time, starting with held to maturity. Held to maturity securities are only debt securities. They can't be shares, obviously, because shares don't have a maturity date. Held to maturity securities are accounted for in the traditional way, at cost on the balance sheet and at cost on the income statement. At cost on the balance sheet simply means at the price you paid for them, which could include a discount or a premium, which would be amortized over the term of those securities. At cost on the income statement simply means that unrealized gains and losses, in other words, increases in their market value, do not count. Gains and losses upon realization, upon sale, in other words, do count, but then, of course, you've sold them and you don't have the securities anymore. Interest income from these securities, of course, goes on the income statement just as it always has. The second category, held for trading securities, can be either debt or equity securities. The idea of these is that they are meant to be held only for a very, very short time and turned over for profit, well, hopefully for profit, very, very quickly. The accounting for these is exactly the opposite of the held to maturity securities and is fairly new, having been included in generally accepted accounting principles only in the past few years. On the balance sheet, these securities are recorded at market price, fair market value, and the assumption, of course, is that these securities do have a quoted market price. On the income statement, they're treated at market price as well, which means that on the income statement, unrealized holding gains and losses do count. So the securities are written up on the balance sheet or down, as the case may be, to their market price at the end of each period. The change is recorded in net income, as are dividend and interest earned, and are, of course, gains and sales on their disposal. The third category of investments is called available for sale. It's perhaps a bit of a misnomer because the company doesn't have to sell them. They don't normally intend to sell these, or they would be called held for trading. In fact, everything that isn't held for trading or held to maturity goes in here. This is the catch-all category, the none of the above or miscellaneous, so to speak. A company may sell these securities at any time after purchase, depending on their original intent, of course. They may wish to cash in or cut their losses or whatever. As long as the original intent isn't specifically for short-term trading or for not trading at all, this is where they go. The accounting is a mixture of the other two. On the balance sheet, these securities are held at market. In other words, they are written up and down to reflect market changes and to reflect holding gains and losses. However, the unrealized holding gains and losses do not get onto the income statement. It's a bit of a hybrid here. On the income statement, we stick to the traditional methods of accounting, which mean that only dividends and interest and realized gains and losses on disposals count. So you're probably thinking, how does this balance in the financial statements then? How do the unrealized gains and losses work? And now we come to a new concept called Other Comprehensive Income, or OCI. It's a new and extra category of owner's equity, and that is where these unrealized gains and losses get stored until such time as they get realized. So owner's equity on the balance sheet now contains share capital, contributed surplus, if any, retained earnings, those are the usual three categories, and accumulated other comprehensive income, which, if it has changed significantly from year to year, could result in the company having an extra financial statement, just another headache for CFAs and analysts to worry about. The income statement treatment of these three classes of securities differs in one important respect. That important respect is not dividends and income. Those are going to be in net income regardless of which classification the security is. That important respect is not realized gains and losses. When you sell a security and you incur a profit or loss, that is going to be an income. The difference is unrealized gains and losses. Held to maturity, they're not recorded at all, not on the income statement. Trading, they are in net income. Available for sale, they're in other comprehensive income, which is not on the income statement itself. Modern income statements will often come down to net income in the usual way, and then they'll now have another line at the bottom where elements of other comprehensive income are added, coming down to a final total called comprehensive income. The name is a little bit confusing because we use the word income for more than one thing. Sometimes, as an accountant, I wish that they'd come up with some other name for it or some other terminology, but they didn't, so we have to live with it, and it just confuses things sometimes from an analysis point of view until you get used to it. So you have your traditional net income, which includes realized gains and losses, dividends, and interest for all categories. After coming down to net income, you have another line, other comprehensive income, which now includes, among a few other things, unrealized holding gains and losses on the available for sale securities. Okay, now here's a short numeric example that will show you how the accounting for the three different types of securities is done side by side, so you can see the differences between them. You might want to get a pencil and paper ready because there's a fair bit of background information that would be helpful for you to copy down. Here's the first bit of it. Let's assume that in year one, a company buys 100 units of security X for $80. Security X can be shares, bonds, it really doesn't matter. In year two, they sell 30 of these units for only $60. So they often have, so they have a bit of a loss at that point. Now there's more information. You might wish to pause the video at the moment to make sure you've copied this down before we give you the rest of the stuff. Now here's the rest of the information. The market value of these investments is $70 per unit at the end of year one, back up to $80 at the end of year two. So at the end of year one, there was a dip in the market price, which recovered at the end of year two. Also, let's assume that each unit pays a $2 dividend or $2 worth of interest each year. And we'll forget about taxes or anything like that for the time being. Okay, so set the stage. We bought 100 of them for $80 in year one and received a $2 dividend. At the end of year one, the market value had dropped to $70. During year two, we sold 30 of those units for only $60, and then at the end of year two, another $2 dividend on the remaining 70 only, and then the market value increased back up to 80 at the end of year two. Okay? Now, here's how we account for these. For the rest of this example, I'm going to show you the accounting and the balance sheet and income statement numbers in 3 columns all together so that you can more easily see the similarities and differences between them.